Forget everything you knew about global finance because the era of traditional banking rails is officially dead. Trillions in sovereign wealth are bypassing legacy settlement delays to move into programmable, on-chain liquidity valves. We are witnessing the end of physical gold as the ultimate collateral in favor of tokenized treasuries. The world's most powerful nations aren't waiting for the legacy banking system to upgrade. They're decoupling from it entirely. Today, we are breaking down the exact architectural shift that is turning static national wealth into high-velocity, real-time economic weapons. You're watching the Signal and Noise podcast. My name is Noel. Let's pull back the curtain on the new global balance sheet. Look, let's get right to the core of the issue. For the last half-century, sovereign wealth funds have operated on a remarkably slow, predictable playbook. I call it the parking lot model. When a nation pulls in trillions of dollars in resource surplus, whether it's oil from the Middle East or manufacturing profits from Asia, they park it. They buy multi-billion-dollar chunks of commercial real estate, massive infrastructure assets, or they stack literal bricks of physical gold inside underground vaults. It sits there for decades, completely immobile, acting as a slow, static safety net. But in the high-velocity, highly volatile 2026 economy, that parking lot model has officially become a massive liability. When global liquidity can evaporate in a matter of milliseconds due to algorithmic cascades or rapid structural shifts, keeping your nation's primary wealth locked in a physical asset that takes weeks of clearinghouse paperwork and legal due diligence to liquidate means you are exposed. You are too slow to react, too slow to defend your currency, and completely at the mercy of legacy settlement delays. The top-tier nations realize they can no longer afford to let trillions of dollars remain stagnant. They needed velocity. So, how do you fix a stagnant trillion-dollar balance sheet? You build a digital twin. The mandatory first step toward global liquidity dominance has been the aggressive migration from holding physical gold and bonds to deploying their exact cryptographic digital twins on-chain. A digital twin takes a heavy, static, real-world asset and transforms it into a frictionless, programmable bearer instrument. You are transferring the cryptographic title natively across a distributed ledger in seconds. But here is where the narrative splits from public crypto and why top-tier nations are completely comfortable running this infrastructure, the automated compliance layer. Unlike public, permissionless networks where anyone can route capital blindly, these institutional-grade tokens have international compliance laws hard-coded directly into the smart contract layer itself. The asset itself forces regulatory compliance. If an unverified entity, an unauthorized desk, or a sanctioned state attempts to interact with or settle a trade using these tokenized treasuries, the smart contract automatically flags and blocks the transaction at the protocol level. Compliance isn't a post-trade audit anymore. It is automated, instantaneous, and mathematically absolute. The regulations are no longer a barrier, they are the code. Now let's look at how this capital actually moves across borders. Historically, cross-border macro trade has been plagued by extreme currency friction. If an oil-backed fund in the Gulf wanted to settle a multi-billion-dollar deal with a commodity-backed fund in South America, they had to route the entire trade through a complex web of correspondent banks, swap into intermediate currencies like the US dollar, pay steep foreign exchange spreads, and wait days for international clearinghouses to settle the ledger. Unified ledger systems completely eliminate that entire stack of friction. By building shared, highly secure, interoperable sovereign networks, an oil-backed fund can now instantly swap its tokenized energy reserves for another nation's tokenized commodity reserves. There is no intermediate currency conversion. There is no foreign exchange desk taking a cut. There are no time zone delays. The value flows natively, peer-to-peer, at the speed of data on a single shared ledger state. It effectively welds entirely different national balance sheets into one cohesive, interoperable global liquidity pool where money moves with zero friction. But the true power isn't just fast settlement, it's how it automates national portfolio management. In the legacy financial world, rebalancing a sovereign wealth fund is a monumental, slow-moving bureaucratic nightmare. Boards have to convene, risk parameters must be manually audited over weeks, and massive market orders have to be carefully sliced up and executed over long horizons to avoid completely breaking the order books. Today, institutional-grade smart contracts handle this autonomously in real time. These smart contracts are plugged directly into global macro data feeds, monitoring volatility metrics, yield curves, and liquidity depths across the entire on-chain ecosystem. The exact second a national portfolio deviates from its hard-coded risk mandate, the smart contract automatically executes fractional liquidations and real-time reallocations across the tokenized network. If a sudden shock hits an equity market in the West, the contract instantly hedges by routing value into tokenized short-term treasuries or digital gold twins globally. It safeguards national wealth 24 hours a day, 365 days a year, without a single human intermediary needing to clear a phone call or sign a physical authorization. But if you want to understand where the absolute center of gravity is moving, we have to look at the democratization of institutional yield. For the last century, the global financial system ran on a single, undisputed asset as its foundational collateral, the U.S. Treasury bill. If you were a bank, a hedge fund, or a foreign government looking for a safe place to park cash and back your liabilities, you bought T-bills. They were the undisputed bedrock of global liquidity. Not anymore. In this new paradigm, fractionalized sovereign debt tokens have effectively dethroned the U.S. Treasury bill as the world's primary collateral layer. Think about why. A traditional T-bill is bound by the friction of legacy settlement hours, restricted clearing networks, and geographical custody limitations. Fractionalized sovereign debt tokens, however, bypass the entire legacy clearing stack. They are highly divisible, yield-bearing, and shift peer-to-peer across global ledgers instantly. Because they are wrapped in smart contracts that natively handle margin calls and automated liquidations, they represent a fundamentally cleaner, lower-risk form of collateral. Major market makers are no longer hoarding paper debt in Western vaults. They are stacking programmable sovereign debt tokens in digital wallets, and that leads to the underlying mechanism breaking open the gates for the rest of the market. Historically, sovereign liquidity pools were the exclusive playground of central banks, mega conglomerates, and Tier 1 financial institutions. The average fund, private equity desk, or retail aggregator couldn't just tap into a nation's sovereign treasury pool. The institutional barriers were simply too high. Tokenization has shattered those barriers by introducing automated private secondary markets that connect directly to these sovereign pools for the first time in financial history. Through highly secure decentralized liquidity automated market makers, AMMs, built specifically for institutions, private secondary markets can now seamlessly tap into, trade, and provide liquidity against fractionalized sovereign assets. If a private credit fund wants to swap out of mid-market corporate debt and directly into a slice of a nation's sovereign treasury yield, they don't need a prime broker or a specialized banking license. They route the trade through an institutional liquidity pool that bridges private capital directly to the sovereign ledger. It's a total decentralization of wholesale institutional access. When you bridge private capital into sovereign assets at scale, you trigger a massive, self-reinforcing economic loop. The global infrastructure flywheel. Think about how a nation traditionally funds massive infrastructure networks, high-speed rail, or sweeping green energy grids. They have to issue massive tranches of public bonds, which requires an immense amount of upfront underwriting cost, extensive marketing to institutional buyers, and restrictive debt covenants that take years to negotiate. The flywheel changes everything. By fractionalizing the ownership or the debt yield of a massive green energy project right from the inception phase, you open up the investment to a global, hyper-fragmented pool of private investors. Because the entry barrier is lowered, private capital floods in from thousands of secondary markets simultaneously. This massive influx of immediate, competitive private participation drives down the cost of capital for the nation issuing the token. Lower capital costs mean the infrastructure gets built faster, cheaper, and with significantly less taxpayers' debt burden. Once the project is live, it generates real-time, on-chain yield that feeds right back into the tokens held by those private markets, which attracts even more capital to the next development project. It's a flawless, compounding loop of capital efficiency. If we project this trajectory over the next decade, the ultimate long-term impact becomes clear. We are moving into a world where economic power is measured by liquidity velocity rather than just total assets under management. For centuries, the global economic leaderboard was simple. Whoever had the biggest pile of static assets won. The nation with the largest gold vault, the most real estate, or the biggest paper GDP sat at the top of the food chain. But in a hyper-financialized, tokenized world, raw size is no longer the defining metric. It doesn't matter if your sovereign fund has $3 trillion sitting in traditional infrastructure if that capital takes weeks to deploy during a macro liquidity crisis. Velocity is the new supremacy. A leaner, hyper-optimized nation with $500 billion of completely fluid, programmable, hot-swappable on-chain assets will effortlessly outmaneuver an old-world economic giant holding trillions in stagnant, paper-bound property. Capital will naturally drain away from slow, opaque economies and flood into the ones that can mobilize, hedge, and deploy their balance sheets at the speed of light. This reality is triggering an aggressive, multinational liquidity arms race. We are no longer just witnessing nations compete for foreign direct investment through traditional tax breaks or trade treaties. The new battlefield is infrastructure programmability. Nations are now actively competing to offer the most transparent, hyper-liquid, and programmable investment vehicles on Earth. If you are a global mega fund or a private credit allocator, you are going to route your capital to jurisdictions that offer ironclad, code-enforced property rights, sub-second settlement times, and zero-friction secondary market connectivity. The Gulf states, Singapore, and tech-forward European hubs are already rewriting their entire regulatory codes to turn their domestic laws into software. The nations that refuse to adapt, the ones sticking to manual court systems, legacy bureaucratic sign-offs, and multi-day clearing delays, will face a silent, catastrophic capital starvation. If your national assets aren't programmable, they do not exist to the global liquidity engine. Let's look at the ultimate truth of this entire migration. The transition to a tokenized sovereign standard is not a temporary financial cycle, and it is not a technical experiment. It is a completely irreversible structural shift that has permanently redefined the very meaning of global wealth. You cannot unring this bell. Once a sovereign fund experiences the sheer power of instant, frictionless cross-border settlement, automated real-time portfolio rebalancing, and the ability to leverage a seaport or an energy grid as hot swappable collateral at 3 a.m., they will never go back to the legacy banking rails. The old financial system was built on trust, paperwork, and political permission. The new sovereign standard is built on objective math, cryptographic certainty, and mathematical velocity. The gatekeepers of Wall Street and the legacy central banks aren't being asked for permission anymore. They are simply being outpaced by code. When you stack all of these components together, you realize we aren't just looking at an optimization of banking software. Tokenization has effectively turned locked, illiquid national assets into a hot swappable currency for international trade. Think about the sheer scale of what that implies. A nation no longer needs to maintain astronomical, idle cash reserves in foreign central banks just to facilitate global commerce. Their physical infrastructure, their ports, their energy grids, their underlying reserves, is the currency. During a major macro trade negotiation, a sovereign entity can instantly pledge a fraction of a tokenized shipping terminal directly for industrial commodities, or use tokenized sovereign bonds as instantaneous real-time collateral to back a massive international supply chain. The physical Earth has been unbundled from its geographical limitations and uploaded into a hyper-liquid cryptographic matrix. The nations deploying this infrastructure aren't just playing the game faster, they are running an entirely different financial engine that operates at a velocity the traditional banking world cannot even comprehend. The old parking lot is completely empty. The valves are wide open. The signal is the programmatic velocity of wealth. The noise is everything else. Make sure you hit that subscribe button, smash the like, and drop a comment below. Can the legacy Western financial rails compete with a hot, swappable national ledger? Or is the old system completely cooked? Let's talk about it in the comments. Until next time, stay mechanical, look for the signal, and ignore the noise.